According to the legendary investor Peter Lynch, one of the most important things when choosing a stock to hold on for a very long period of time is to not buy it just because recommendation from random media said so. Just because you came across some random YouTube video that told you should buy this stock now or never because it will shoot up to the moon because of reasons such as technical analysis of the stock graph. Sometimes it can be hard to resist this temptation and hitting the buy button, but as most YouTubers say, you must do your own research and develop your own faith in the company you're interested in buying. Let's look at the steps that compose Peter Lynch's decision tree of deciding his next potential 10x stock. First of all, he states you should put more work in picking your stock than when you go shopping and try buy the better product at a lower price. He emphasizes that buying a stock is not participating in the market, but is investing in a company and becoming part of the company. This is very important in a psychology perspective. So Peter Lynch has one buy signal, and that is when he finds a company he finds really interesting. He does not care about market timing. Peter Lynch usually searches out interesting companies in the making by looking at the products and services around him and his family. He listened very carefully to his wife and kids about the products and services they found satisfying and started research on it himself. If he found a certain product A very profitable and innovative, he would first look at how much percent of earnings this product is for the company providing it. No matter how successful the product was, if it had a little portion of the company's portfolio, it would not impact or increase the company's overall earnings. In this case, Peter Lynch would not invest in this company, but otherwise, if it was a major portion of the company's portfolio, Peter Lynch would start his next step of stock analysis, which is identifying what type of stock this company is. According to Peter Lynch, there are 6 types of stocks: slow growers, stalwarts, fast growers, cyclicals, turnarounds, and asset plays. The key points of each type of stock is presented in the picture above. Stalwarts are companies like Coca-Cola, P&G, Hershey's, etc. Usually, stalwarts show a yearly growth rate of 10 to 12%. A stalwart stock investor needs to have a time frame of tens of years to actually make some profit, so it is hard for a stalwart stock to become a 10x stock. On the other hand, they can be reliable hedges against bear markets. Fast growers are small, aggressive, and relatively new startups. They can be potential 10 to 40x stocks or even as high as 200x. But of course, high return comes with high risk. Peter Lynch reduces this risk by searching for a fast grower with a stable balance sheet and high profit margins. With this method, we can pick out our next 10x stock. What we need to keep in mind are things to be careful when investing in a fast-growing stock. First, deep understanding of the fundamentals of the business is a must. With the fundamentals, you can analyze the company in more detail and grow more faith into the stock. Second, you need to see whether insiders are buying or selling. The more insiders buying their company's stock, the more faith you can have in the company and its business. If insiders are buying, you wouldn't have to worry about bankruptcy of the company. Third, we need to avoid stocks that are popular among people. As more hype is formed around the stock, the higher the stock price rises, forming a bubble. The problem here is that when hype or speculation is not fulfilled, the stock is likely to plummet down and people panic sell. Finally, avoid stocks that are the next something. In history, whatever company that was called the next Apple or the next Amazon or whatever did not turn out so well. So if you want to invest safe in a stock with a lot of speculation around it, you can wait until the company actually records expected earnings. The value of the company always comes down to assets and earnings of the company. This is why traditional value investors like the PER ratio so much. They believe that the price of the stock will always level with the earnings of the company in the end. The next step of Peter Lynch's decision tree is to get a full picture of the company's business story. This means understanding what kind of anticipation one can have on this company and how it can grow its business in a sustainable manner. One way to do this is to speak to yourself for about 2 minutes about the factors required for the success of this company, why you feel interested in the stock, expected obstacles for this business, and so on. But you need to be careful to not fall in love with the stock and start making up factors that aren't real. To summarize, the key points you need to keep in mind for picking out your next 10 stock is 1. Buying a stock means investing in a company and being part of the company. 2. Define what type of stock the company you're interested in is. 3. Understand fully the fundamentals of the company and its business before buying. 4. Get a full picture of the company's business story for sustainable growth. If you learned anything from this video, I would appreciate a thumbs up and a subscribe if you're not subscribed to the channel. If you stuck to the end of this video, I appreciate you so much. You're an absolute sunshine, and I hope to see you in the next video. Peace.